the most important part in choosing your corporate structure is understanding the end game. What are you trying to get to? The second thing is how long you're going to keep this business.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
So this is John Smallwood. I want to welcome you today to Money Isn't. Money Isn't means a lot of different things to a lot of different people, right? And when you think of it, you have to step back and what pops in your brain and think about, when you step back, do I think about money the right way? Do I love my money or do I hate my money? I'm joking, okay? But the reality is, do I repel it or do I attract it? Do I keep it or does it keep fleeing? And those are decisions that go on and happen a lot. Now, my father used to say money isn't everything, but without it, you can't get a date. So money means a lot of different things to a lot of different people. And I think one of the things that I get a lot of feedback on is, I'm a business person. I own a business. I want to start a business. I want to do something. Is what kind of structure should that business be? Should I be self-employed? Should I be an LLC that's taxed like a partnership? Should I be an LLC that's taxed like an S Corp? Should I be an S Corp? Should I be a C Corporation? And it really comes down to, what are you building? And what is it that your future, and that's why money isn't, like, what is it that you want to achieve with your business? Are you building a business to sell it quickly? Well, there are certain, in today's tax law, there are certain economic benefits attached to owning a C Corporation, that the first $10 million of a sale per person could be tax-free. The caveat, catch-22, the linchpin in that conversation is, the entity buying you has to buy your corporate stock. If they buy your assets, you're getting taxed. So I see a lot of people structured as a C Corp, and they end up selling their assets and paying taxes on it. And I'm like, why the F were you a C Corp? Because that has other issues, okay? Everything has a pro and a con, meaning one thing creates an equal and opposite reaction, okay? So what I thought would be helpful after the last episode that we did, I got some interesting feedback, and I think taking the feedback and having this conversation is like, okay, I get this sunsetting. I get the pass-through entity tax. I get it. But why aren't you doing it? No, I get it. But okay, I don't even know if I'm structured properly. And the conversation that we hear frequently, and I hear this over and over again, is I give my stuff to my accountant and they give me back my finished taxes, and I write checks. And I don't really know how to check it. I don't really know whether it's right. I don't know if I could have paid less. And then I repeat that same process 12 months later. And I'm as dumbfounded and as blind as I enter that process again. I don't really get that. Why that happens over and over again. I get it because of time and money and, the frequency in which you're doing things. And this is something that at Smallwood Wealth, I feel that tax planning is one of the most important parts of the wealth management process. And without good tax planning comes shitty results. And when you have shitty results, you're not maximizing the value of your business. You're not maximizing your wealth. You're not maximizing your lifestyle. You're not maximizing the things that are going to be really important. And we're not going to be talking about the myriad of deductions that I could be doing inside of a business. I'm simply going to look at it and say, let's pretend for a moment that we are a self-employed person who's gone out on our own and is filing a Schedule C, which means it's not an entity. I am basically doing business as something, and all the income is filed on my personal tax return as a Schedule C. Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. A Schedule C is something that is really interesting because you get to see gross income, you get to take deductions, you can take car deductions, but it's typically a self-employed person, one employee structure, easy business. Now with that comes liability issues and things like that we're not going to be talking about in this podcast. We're going to be talking about that in other shows, right? So this entity structure, and I basically simulated a couple things using some of the simulation software. And what I did here is I said, okay, we have an individual. He or she is 54 years old. We can make them younger, but let's make them born in 1985. Let's just move the thing up. So did I get that? 39 years old. And we've gone out on our own, and I'm going to have $100,000 of net self-employment income. So let's understand the impact of self-employment income. So when you worked for the company that you work for, you paid something out of your cash flow called FICA and Medicare tax, right? And that cheat sheet goes up to like 160,000 this year. I forget what the top deduction is. What you're paying FICA and Medicare up to. It's around 160. Let's see if I can find it really quick. Give or take. Okay, I can't find it. Doesn't really matter what the number is because at that 160, you're paying 7.65%, plus the company's matching 7.65. And then there's Medicare that goes above that, which is 3.25 or 1.52 on the other side. So if I go to Schedule C, I now have to pay the self-employment tax. Oh, what do you mean? Meaning that's that 15.25, the 7.65 plus the 7.65 the company was paying, I now have to pay. And I also have to pay federal income taxes on it. So when I run my simulation here and I go to the tax strategy, so here's, very simple tax return. Single human being, $100,000 worth of income, $14,000 standard deduction. We're getting, with the $100,000, this person is getting qualified business income deduction because they're under a certain level of $15,000. So their taxable income after deductions in QBI and all those other wonderful things is down to $62,000, which creates $8,840 of federal income taxes. But your self-employment tax down on line 23, down here, line 23, is another $14,130. So your total tax is $22,970. That's pretty painful. I remember getting those things like, what? What the F? Nobody told me this. Because money doesn't come with an instruction manual. Business entity doesn't come with an instruction manual. So let's think about that. It's $22,900. And this person who's self-employed, when they get to 2026 and we go to that sunset, as we talked about earlier, right? Didn't we talk about this in one of the previous things at the sunset, potentially if it may or may not happen? What the F am I talking about on a sunset? The 2017 tax law sunsets potentially automatically in 2025. The powers that be in 2025, that's the last year of it, have to do something different or say, let's reaffirm that. Who knows if that's going to happen, right? But what happens here is the self-employment tax, the same $100,000, is taxed at $14,000 still, but the federal tax jumped from $8,800 to $15,000. So now we're at 29. So when you look at a chart, like you go from effective bracket just under 30% to effective bracket at 35%. you think that might have some impact on your disposable cash flow and your net wealth and your ability to accumulate wealth. So let's go through the separate options. What if I become an LLC that's taxed like a partnership? That's an option. What if I take the same 100K and say, let's make it taxed like it's an LLC taxed as an S Corp? Do you know if your LLC is a partnership or an LLC? I mean, an S Corp. Do you know how you're being taxed right now without getting out your tax return? 99% of people don't. So let's do that, right? So just remember 22,000. What do we got? We got 20 in today's dollars in this year, 22,970. Let's round up. Let's call it 23,000. So now I'm going to go over, I'm going to get rid of my self-employment income of 100,000. And I'm now going to go wrap it in my LLC that's taxed like a partnership. So I'm going over to here into the simulation software, and we're going to put this in, and we're going to say, here's our $100,000 worth of taxable annual income. And we're going to say the distribution is 100,000 and it is subject to service income. And I run it through that same model. And now I go to the same tax return and I go to the same thing, and it's $22,970 because I got to pay the self-employment tax. The company's got to pay. You are the company. It's a pass-through entity. Now, are you taking advantage of the BATE tax? Are you in New Jersey, or the pass-through entity tax in 35 other states? Are you paying your corporate tax? Are you paying your state and local income tax through the entity and taking a deduction? That's going to lower that. Okay. Now, an LLC taxed as a partnership, you're basically not getting a salary. It's a guaranteed payment, right? So it's still 23,000. And guess what? When you roll through the end of qualified business income and you go to the 26, we're still at 29.6. So what did that really do for us? It picked up an asset protection. It picked up a couple other things. It picked up the ability to do the pass-through entity tax, okay? To pick up that BATE tax. It picked up, are we qualifying for the QBI? Are we doing the right thing? So I want to jump through this and say, well, what if I built an S Corp? I have to have in an S Corp, LLC taxed as an S Corp, I have to have what's called reasonable compensation. Reasonable compensation means somebody's doing my job. What's a reasonable salary that I would pay that person to do that salary? Like if I have zero salary, is that reasonable contribution? But I'm just going to do one thing. I'm just going to switch the entity from LLC to S Corp and do the same $100,000 pass-through entities. I'm not saying you should do this, but when you do this, you need to pay yourself a salary. When you do this, your taxes are $10,000 as opposed to $23,000. If you pay yourself a reasonable salary and say, I'm going to pay, myself a salary of, arbitrarily picking out of my ass here, $50,000, okay, having fun. And I'm going to drop this down to my distributions now going to be only $50,000 because I'm paying myself partial salary. My tax, when you look at the federal tax return, it's down to $11,681, but you paid FICA. You paid 7.65 of FICA on the 50K, and you paid 7.65 on the corporate level paid it also. But you're only paying the 7.65 on 50K as opposed to 100K. And self-employment, you're paying the 15. You're paying twice that, right? So we reduced it. We didn't eliminate it. And you do want Social Security because if you don't, you're going to have some problems, okay? So now we're not talking about 401ks, solo case, SEPs, and simples, and Roths, and all this kind of stuff, right? We're not talking about that. I'm just talking about entity today, right? Because this is such an important thing, and I want you to think through what I'm talking about. I'm going to go back to the profile. If you're watching this, if you're listening to this on the thing, there is a YouTube with this video, and I am sharing my screen, and you will see the screen here because I am recording. I'm going back to the 100. I am just checking that to make sure that I am. I've been known to not. 100K. And what we're going to do is we're going to switch it to a partnership, because I see a lot of the partnerships out there where they come in and they're, a 1065. If you file a 1065, you are a partnership. But when I run that tax and I run it the same way, it's the same $23,000. What did I pick up? Asset protection. As a partnership, I can pay myself a guaranteed payment, but that's still going to have the same problem. What I want to talk about is, as I go down here, if I'm in a C corporation, the question is, think about a C Corp. For me to pull the 100,000 out, the only way to get that money out is out through payroll. Anything I leave in the corporation is retained earnings and it's taxed at the corporate level. Those retained earnings, to get out, I got to pay tax to get that money out. So potentially what we're doing is subjecting ourselves to double taxation. Corporate tax is 21%. So if let's say that I pull out 50 and I leave 50 in the corporation, I'm only paying tax on the 50, but I pay 20% at the corporate level. And when I pull that 50 out, that retained earnings, I got to take it out through payroll. But if my sole purpose is to sell the business, I've got a hot.com thing, I've got an AI thing, I got something that's going to be, hey, I can sell this and flip this in 3 years for 10x. You might want the C corporation, in as much as you got to look at the landscape. People that are in your space, are they selling the assets, or are people buying your stock? If they're buying your stock, you qualify for that thing. I haven't seen a lot of transactions where people buy the stock. I have seen a couple of them that are massive, and there's multiple owners and they sell for a couple $100 million, and maybe you're getting 8-10 million and it's tax free. It is unbelievably powerful. So the question comes down to, when I sit back and you think about it, the most important part in choosing your corporate structure is understanding the end game. What are you trying to get to? The second thing is, how long you're going to keep this business. My position is, the more successful a business is, the S Corp typically sets up as a longer term, better entity. And you see this, let's say that I'm self-employed and I'm going to make like $1 million per year, like $1 million. I feel like, what is that movie? $1 million. Oh my God, what's the freaking movie? I can see it. Little guy, $1 million. Austin Powers. Oh my God, my head is blown. Austin Powers. So I'm making the $1 million, right? And it's like, oh my God. So I pay my accountant says, pay yourself $1 million salary. What did I just give up? I see this all the freaking time. So on every 100,000 that I earn over, let's just say 200,000 for that FICA Medicare thing, like 160, right? Ish. I got to pay Medicare tax of 3.25. So if 800,000 times 3.25 is $24,000 of just additional Medicare tax paid. Opportunity cost. I could put my kids through college for a portion of that. That could go into a savings account, right? That can go into a tax-free account. That is money getting effing pissed away in bad planning. Now, what I'd also give up? BAIT, pass-through entity, and qualified business income. What if I brought the salary down to 300,000 and had an S Corp distribution for 700? That 700,000 has no Medicare tax on it. There was a person who ran for president many, many years ago, a very successful attorney. He did that. He made like 25 million. Mr. Edwards down in South Carolina, right? And everybody was mad that he did that. But it's like, it's the tax law. It allows me to do it. All right. And he was a Democrat. Oh, okay. I do that. I now reduce the Medicare portion dramatically, which is a massive savings, right? And now let's say I'm in an entity where I get BAIT tax in New Jersey. So I take the 100 that I would have paid in New Jersey tax and I pay it through that. So that drops that tax exposure down to 6. And then I get qualified business income of another 20%. That's another 120,000. I'm only paying tax on 500. I just dramatically reduce taxes. Math. We're just moving money around, right? We're just moving shit around on the tax return. It's the same money. And that's why planning and simulation and strategy is what makes the most sense. And understanding where you're going. One of, when we do our wealth curve conversation, right? We do the wealth curve conversation. It's a free, no obligation conversation. Free, right? No obligation to do anything with us. But our goal in doing that conversation is to understand, tell me about your family. Tell me about your business. Tell me about your partners. Tell me what you want to achieve. Tell me what's going on there. Like, is this business something that you're going to be 10xing, 100xing, 1000xing? Different strategies. Or I'm getting ready to sell it. Or I don't know. Or I work for a company. But this conversation really helps us understand who you are and what that money is or isn't to you, right? Because if we understand the dynamics of your plan and then we get to design with you, because you're the expert at what you do. You are. I am not the expert at what you do. I am the person who's going to be looking at your chess game and saying, well, what if we move this piece and this piece and this piece? What's the equal and opposite reaction? Do I reduce taxes and reduce risk and fees and costs? It's funny. When we go through the wealth management process, there's a fee to do the wealth management process. And what I have found is I can't guarantee it, right? But in almost every case that we work on, whether the person's retired or a business owner, the business owner especially, right? Because there's so much waste and leakage going out on a business owner. It's not uncommon for us to recover 2 to 3x what they spent in the investment fee. And everybody's like, maybe you should have a higher fee. I'm like, maybe I should. And I look at my competitors and they have higher fees, right? So subject to change. But my idea is, if we don't understand you and we don't give a shit about you, then what kind of plan are you going to get? You're going to get some, to buy this product, shove this up, your plan, do this, do that. There's got to be a rationale. There's got to be an understanding. There's got to be a reasonable way to think through this, right? And by understanding this wealth curve conversation, we now understand the framework and whether or not we're a good fit for each other. Our firm, are we a good fit for you? We have advisors that have worked with young and upcoming people, work with retirees, work with high-level corporate executives, work with business owners. My love is in the business owners and the high-level corporate executives, but I get nothing more enjoyable than working with somebody who, we had a great client recently who started a side hustle. Working for a company, had this dream, and she started this other thing, and it's becoming really successful. And it's pushing through that to make it even more successful with her and keep going. And I think what's amazing to me is you have so much more potential than what you're actually doing right now, today. And if you stop thinking about all the stuff that you're worried about that may or may not happen, and you focus on what it is that you want, and you enter the process, you enter the conversation, you enter your business as, I'm going towards this. Everything that happens in between that is noise and it's feedback. And typically it's something that I haven't addressed that I need to just fix. And when I fix it, like, imagine you could reduce your taxes by 20 or 30%. Will you not be better prepared when you hit the sunset? You will be, because you already reduced taxes, because you have a better strategy. Now, could that go away? Could that put us in a position where we need to do more tax planning? Yes. And I'm going to say good tax planning starts every year. It doesn't start in April. It starts now. And it starts, because you can't change last year. You can only change this year. So if you are a business owner and you have an entity and you had to look up what your entity was, I would guess you're paying more taxes. I would wager that. I don't know what the wager is. Somebody said to me, it should be $1. And I said, what? He said, $1. And then I really listened to him and he said, doll hair. He didn't say dollar. I was like, come on, you afraid to wager? But we think this is really important. And I also think it's really important to stay focused on what you want. Too many people get to the end and they're like, oh, I got a buyer. I'm going to sell it because I just want out. I want out. And they sell their companies for pennies on the dollars, which is really good for buyers. It's really, really, really good for buyers because if you don't understand your books and they knock your books down, like let's say you got an S Corp and you're making $1 million a year, and let's say your business sells for 5x, $5 million. But your bottom line could be 1.2 very easily. And yet all these other things that are in your books are add backs, like stuff that goes on in your business that's not going to, if a buyer comes in and buys it, it's not there. They're not going to have those same expenses. If you can take the business and say, I get it to 1.2 million and I have the same 5x, that's another $1 million. So instead of getting 5, you're getting 6. Whoa, that's powerful. Last I checked, right? So you have to think about it. If I'm building the business to end, do I know what the key performance indicators are for the business, for the SIC code that I live and operate in? Am I making my business most profitable today? And do I understand the elements that should be added back in to get full value for my business? Because a lot of people are better off not selling their business, but just putting in strategic management. But the dollars, from an investment side, well, the investment advisors want to get your money under management. The business broker wants to get the transaction, wants to sell it. I don't know if it's right unless we talk. So this was fantastic, and I truly appreciate it. Now, if you found value in what we discussed today, please like us, share us, look us up at smallwoodwealth.com. Sign up for a Wealth Curve conversation. There is no obligation. There is no cost for it. And my feeling is, as you can tell, if you're not interested in what we do, we're not going to bother you. If you're interested in what we do, we're going to bother you because you want this. And if you don't want it, that's fine. That's your point in life is where you are. So thank you and have a wonderful day.